Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video to start 2022 with our friends at Strategas. I'm thrilled to be joined today by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
Good morning. I'm doing great.
Great. Well, it's fortuitous to have you here today because the big move to start the year has been in the rates market. It's been in the bond market, and I think that's what's been driving a lot of the equity movement. So we've seen a big jump in yields, particularly long yields, but I just want to get your main thoughts. What are you seeing out there right now, and can it continue?
Yeah, well, let's just be very clear. We're seeing movements both on the front end of the curve as well as the long end of the curve. So this morning, we're seeing two-year yields pushing up to about 86 basis points. That's about, we'll say, 10 basis points or so above where you'd expect to be if the market thought the Fed was only going to raise rates or hike rates 3 times this year. So the market's starting to say the March meeting is in place. So that's one point. The other point is on the back end of the curve. And as you mentioned, you're seeing long bond yields, 10-year yields now about 175. They're up about 25 basis points over the last week and a half or so. What that is really telling us is the bond market does absolutely expect the Fed is going to begin to reduce the size of its balance sheet. That is, in other terms, that's been called quantitative tightening or balance sheet reduction. But no matter how you phrase it, it means that the Fed is going to more rapidly be pulling liquidity from the bond market in 2022.
That's a really great primer on that topic because I do think it's a bit outside the realm for most investors. And you mentioned that both short-term and long-term rates are headed higher. We've seen the yield curve steepen. That is the difference between long and short-term rates, but not all that much because everything is going up. So when the Fed starts hiking, this will be the tightest that yield curve spread has been in quite a long time. So I wonder, what does that mean for the pace that the Fed can tighten at? What does that mean for them going forward?
What it means is that the Fed, this is more a concern for the Fed right now than, say, the equity markets, because what it means is that when you tighten on the front end of the curve, thereby you raise short-term interest rates, you put more of the burden of tightening, of tighter monetary policy on Main Street, small businesses, small-time investors, households. Auto loans, things like that, things that have short-term borrowing, rolling of the short-term debt. In contrast, when you use the balance sheet to tighten, you put more of the strain on financial markets. No surprise, long-term treasuries, corporates, equity markets. So the implications are, as the curve is flattening, really, or even as you see right now, a 2-10 spread of, we'll say, 80 basis points, even if it doesn't flatten any further, it's a warning sign to the Fed that you cannot move as aggressively on the front end of the curve without doing damage to Main Street. That is, they have to go slow with their rate hikes. Now, it seems like from the Fed minutes yesterday, that's exactly what the central bank is indicating. They recognize they have to go slower than they otherwise might have wanted to in terms of rate hikes, and they have to use the balance sheet actively reducing their treasury holdings, because otherwise they're going to put too much pressure on Main Street, and too much of the burden of financial market, I should say, of monetary tightening is going to fall on households if they otherwise don't use the balance sheet.
That's great insight. So I want to finish with this. We've been talking about how aggressive the Fed is getting and how hawkish everything seems. But is there any risk to the downside for all of this? And when I say downside, I mean a less aggressive Fed, fewer rate hikes, no balance sheet runoff, whether it's because the personnel gets more dovish, because inflation moderates as supply chains clear up. Is there any risk to the downside for this outlook?
Well, yes, there is multiple things. And I think you highlighted all of them. One, there's going to be a change in leadership in the Fed, presumably sometime starting in the second quarter. So therefore, that change in makeup could result in, all things equal, just a more dovish Fed. Another factor is that on a year-over-year basis, the inflation numbers are going to start to look better, probably again sometime around second quarter. So the Fed could have some, at least statistical reason to say, well, we can slow down here. But I think the one that people focus on the most is the one I put the least credibility on. People seem to think that there's an equity market trigger, that is some level of pain that the equity market can sustain such that the Fed will slow down. And I take a very novel or different approach that I think the S&P 500 could be down 100% and the Fed doesn't care as long as it doesn't affect Main Street and it doesn't affect the ability of companies to borrow in the corporate bond market. Now, with that said, obviously, there's some level of stress or strain on equities that threatens credit creation. What is that level? We don't know. But in the past, it seems to be somewhere greater than 15% downside on equities before you start to see credit markets really begin to buckle and households from the wealth effect really begin to feel some pain. So if I had to guess, somewhere between a 15 to 25% downside on equities is what gets the Fed to really start to pull back and say, wait a second, we're threatening Main Street, we're threatening savings, and savings is going to have to be a big part of the US economy in 2022 because there's less federal government stimulus. So savings are going to be dipped into irrespective of what happens in the equity market. So the Fed has to be cautious. But I think we're a long ways away from that right now. I think S&P 500 from its peak, we'll say it's down 1.5%. So we got a ways to go before we have to worry about that threshold.
Yeah, outside of the coronavirus, we haven't seen volatility like that in quite some time. So a lot to watch for. We really appreciate the insight. It's been great to start the year out like this. Tom, thanks so much for the time.
My pleasure. Thank you.